Let's continue on the income statement analysis. Some of this you've already touched upon. The first thing is a trend is most important. Is it showing us what direction we are going over a period of time? Oftentimes, sales growth is expressed as a percentage over the prior period. Sometimes it's year on year, sometimes it's one quarter to prior quarter, sometimes current quarter to same quarter last year. When you compare quarters, remember you got to take into account seasonality, okay? Because the current quarter this year it can be comparable to the same quarter last year when you're looking at a nursery or a retail outlet that focuses for things for Christmas. Quarter to quarter is when you have a smoother one. We oftentimes look at compound annual growth rate, what's happening over a 3 or 5 year period. Again, we're looking at trends in sales. What is it telling us? Because then we look at the strategies and say, are the strategies the firm is trying to execute actually working? And then if it hasn't started, based on what we've seen, do we think that strategy is going to work out? As we keep going, we start with the gross margin, which is net sales revenue. Remember, some companies call it sales, some call it revenue. Less cost of goods sold, or cost of revenue, equals our margin. And oftentimes it's expressed as a percentage of sales. Okay? And what this does is this enables us to evaluate sales growth in connection with the underlying costs. So when you think about what could happen is from period to period, if your revenue sales stays the same, we would like to make sure that the cost, the margin, stays the same or gets better. Okay, because that means they're putting in operating efficiencies. However, if we have sales being the same and we're seeing the gross margin deteriorate, well, they're not controlling expenses. Conversely, if we're looking at growth should cause the gross margin to go up or stay the same. We should not see the gross margin go down, because that would be telling us that the incremental sales weren't helpful to the firm. Okay? So we tend to look at they going up, which is what we'd like to see, or staying the same. And sometimes we got to take a deep dive to understand that. Net margin, net income divided by revenue, net profit margin, measures the amount of income that a company was able to generate for each dollar of revenue. That takes all the costs into account, not just the cost of goods sold, but all the general and administrative. The higher the level of net margin, it indicates higher profitability. So some stores simply have a very low gross margin. When you look in the grocery business, 0.5% to 1%. Okay? Net profit margin can also be found directly on your common size income statements. Okay? So once you do this in Project 2, you're going to be able to look at what that profit margin is, because that's important as to how much of that dollar actually translates to profit. It's also a return on sales. How much are you making?